So what would a high frequency trading algorithm entry be on a buy model high frequency trading algorithm? You can see very plainly that I outlined that we would likely draw up into the consequent encroachment of this wick here on the 15-second chart, and then potentially draw to here. Now the draw I'm thinking is up here because it's going to move on the folks that see this as a high, low, break and retest, and try to go lower. That's what the algorithm is running on. It's already ran to the majority of the position holders here because their stop would have been right above here. So the short holders that would use this as a short, this run into this inefficiency right there, into this order block, that's a trade. That's a high frequency trading algorithm, but that's for the sell side. So the opening here, it trades down into that. And then we have a short-term high. It's broken to the upside. So now think for a moment. Your mindset is, I'm strapped in, I'm in the saddle, I'm only running for buy side. So the high frequency trading algorithm that you would be studying in this fractal, in this type of price action, would be only looking for longs or only looking for buys. Okay. And how could you use that? Well, what have I taught you? What were the signatures that you've understood so far about what price uses to go higher? You have to have a shift in market structure. Here, you have a swing high. It rallies through it on this candle right there. It runs higher. That's fine. But what does it leave? Small little inefficiency right there. And it just ran our target there. So a order block, okay, is a change in the state of delivery. It is a frame of reference where a change in where price will be drawn to or from, that occurs here. Why am I using this down close candle and not this one over here? This one has the larger body. So it spent more time and recorded more time and duration at its extremes. That lowest close, that makes this an order block. This swing high that it's part of, when it trades above it here, that's a shift in market structure. So that means high frequency trading algorithms will trip to buy side, and they'll all be looking primarily for the largest leverage to be on this side of the marketplace. Now, the chaos high frequency trading algorithms that trade up and down all day long, they'll take this trade too, but they'll also take this short in this fair value gap here that trades to it and trade back down into this inefficiency and change in the state of delivery, which is that opening price. Here's the opening price, fair value gap. How do you qualify a high probability order block? It will have my fair value gap. Not every down close candle is an order block. Not every down close candle with a fair value gap like this is a long. Wait, that's a contradiction. No, that's a refinement. I'm teaching you narrative, logic, framework. The fact that we had this idea here, what was the first side of liquidity taken at CPI? We opened here at 8:30. It opened, rallied up here, stopped short, and then went down below to take the buy side. I'm sorry, to take the sell side. So you have what? A delivery to sell side burst. So smart money, wait for this signature here, because the first, that tells you the direction, because they're going to run for sell side first. So this is the reason why I told you I believe it's going to go up here. How did you know that, ICT? How did you know it's going to go higher? Why did you pick that? Why didn't it want to come back down to consequent encroachment of this wick? That's what some of you are probably thinking right now. It doesn't need to go down to the consequent encroachment of this, because the narrative is it ran for sell side and then quickly repriced away from it. It does not need to come back down here before it goes up to the buy side. And how it delivers, listen folks, how it delivers price after the second pool of liquidity is engaged. Sell side was below here. The sell side was taken first. That means the move will be likely prolonged and much more prominent to the buy side. That means it's going to go higher. It upsets the orders and sentiment by this drop down here. Then it runs for the buy side. It breaks lower, comes back up, and then creates a false shorting opportunity. It delivers a short run. Traders see that we're short. They thinking, yeah, wow, I got 4 handles, 5 handles or so. I'm getting ready to take out that low down here. It's going to keep going for the rest of the day lower. Wrong. It only reprices to the opening price here at 8:30. Opening price trades down. Look at the bodies. They tell you the story. The wicks did the damage. The body stops right at the opening price at 8:30. The algorithm receives that as information, comes back down to it. There it stops on a dime, turns around, creates your short-term shift in market structure there. Down close candle, bullish order block, separation here, come back down into it, hit the order block, respect it, close in the inefficiency, time distortion. All of this movement in here As long as we're not breaking below the midpoint of this down close candle, everything's still a go. What I'm looking at is this range from this high of this candle down to that low. As long as these two candle reference points here have not been breached above or below, all this stuff in here, I'm ignoring every bit of it. I'm not looking at any fair value gap inside of that. I'm not looking at any kind of potential order block, because this range here, that's your dealing range, it will not be anything of any importance or significance unless it trades outside of that range. So all of these candles from this green candle right above my cursor all the way until we get to this candle's high right there. So this candle all through till here means nothing to me. I'm not looking at any of those candles and having any respect of anything it's doing, because the return from this fair value gap here, the market rallies up into that inefficiency again and trades down, only to offer delivery to the order block, close the inefficiency, and then time is spent marking time. That's it. We're in 15-second candles. So it's just hanging around. What is it doing? What do you think's occurring inside of all these ranges in here? Between this candle's high and this candle's low, that's all one order block. What kind of order block? Propulsion block. So my mindset in focus is inside this range. Everything that's happening inside it, I could care less. But my mind as a trader and the analyst is I'm looking at inside this range here. I want to see this range maintain itself and then eventually break to the upside, which we get right there. Where does it draw to? Where I told you, here. And then what does it do? It stops and then consolidates. What's it doing? What is it doing, folks? Think. The order block, it trades down to it. It's spending time down here for traders that are in the know. It's allowing them to get their orders in before the algorithm reprices. And then it goes to our first point of reference, which is the consequent encroachment of this wick here, stops, and then spends time. What's it doing? Allowing them to build a larger position. What's the model? Where's price being drawn to? Higher. So it allows them to accumulate more longs. And then as it runs up, they're distributing it. All their initial entries in here, they're selling it some in here, and then new algorithm entries are in here, accumulating more. And as it runs up, they sell, and that provides liquidity. So there's this dance that's always occurring between inefficiencies and liquidity. Premium to discount, discount to premium. Always. That's what's occurring. So 1 minute, opening price, we trade down to it here, we rally up, consolidate around. What's it working in here on the 1 minute chart? Mean threshold, rally. Consolidate, allow smart money to accumulate more longs and displace into the upside. Now look what's occurring here. We're getting short-term highs. We run above it, short-term high, run above it. When it starts creating these short-term highs, every time it runs above that and you're long, high-frequency trading algorithms are dumping portions of their position above that. That's why I do it. Okay, I'm in there doing the same thing that these entities are told to do when they work with this algorithm. They're doing it because it's a purpose in mind. They're offset distribution. If they have accumulated long positions in here and in here, how do they exit? Short-term highs, move away from it. Above that high is going to be buy side. Sell to this buy side. Creates a short-term high, retraces back down in, creates a short-term high. When it runs above it again, sell, offset, distribute. Offset their long positions and distribute them to willing buyers. Smart money distributed. Real time, I was explaining it to you. And look where we're drawing down to the high end of that buy side liquidity pool.